Hello, my name's Peter Mauthe. I'll be the presenter today for Trademark Capital Management's review of the May 2025 FOMC meeting. Let's get right to the slides. The May 2025 Federal Reserve meeting notes are as follows. Obviously, there's no change to interest rates. This was completely expected that interest rates will stay between 4.25% and 4.5%, averaging out at 4 3/8. Uncertainty is increasing, Chair Powell said, and therefore that's reason to not make any interest rate change at the present time. He went on to say that risks are rising for both inflation and employment to increase, meaning unemployment to increase. Also, the Fed does not need to be in a hurry to change interest rates because there's too many unknowns still about the impacts of economic policies being implemented by the administration. And lastly, for the time being, the Fed will wait for clarity in the economic data. Now, that's likely to take well into July and possibly September's meeting at this point in time. This graph we've shown before. This is prepared by McClellan Financial, and it's a current graph. This shows the 2-year Treasury note in green, and it shows the Fed funds rate in black. The important thing about this chart is that the 2-year Treasury note, as dictated by the open market, as opposed to the FOMC, tends to lead the FOMC's changing of interest rates. You can see this going back to 2022 when the Fed started to raise interest rates. They raised interest rates well in advance, or I'm sorry, the 2-year Treasury note began to increase in its yield well in advance of the FOMC meeting. You can also see this happen back in 2016 and 17 as the open market took the yield on 2-year Treasury notes up well in advance of the Fed doing so. The reverse is also true. You can see where the 2-year Treasury yield tends to decline well in advance of the Fed. Here again, this happened last year when we saw the 2-year Treasury note begin to decline well below the federal funds rate. And here we are once again with the 2-year Treasury yield well below the Fed funds rate. Now, this does not mean that there's going to be an imminent change in interest rates. It just simply means that the open market is anticipating that the next move by the Fed, whenever it does occur, will be a lowering of interest rates. Now, taking a look at the current yield curve, it is anticipated that sometime over the next 2 years that the Fed will come to bring interest rates down to the 3% level. This is shown on the left side of the yield curve, which is showing the yield from the 30-year Treasury down to the 1-month Treasury on the left. The black line shown at the top of the screen is the yield curve as of 1 year ago. The blue line is the yield curve as of this week. Now, the dashed green line is showing the typical slope of the yield curve under normal economic conditions. And if interest rates are lowered to 3%, as is expected sometime over the next 2 years, you can see that short-term interest rates out to about 1 year will decline fairly substantially. But the interest rates going from 2 years all the way out to 30 years are already approximately where they are expected to be if the Fed does lower rates to about 3%. What I've highlighted here in the vertical shaded areas are the 5-year Treasury yield tends to be a good guiding light for what car yields will be based on. And you can see that if the Fed does lower interest rates substantially at the short end, we might get a small decrease in car loans, actually a small increase from this level, but from a year ago, we would only see a small decrease in car loans and very little change in home loans or mortgages in that regard. So the yield curve out here to the right, the longer term end of the yield curve, is already anticipated where the Fed is going to lower rates eventually. Now, what does this really mean for us as investors? It means we're going to experience a very gradual decline in interest rates for money market funds and savings rates over the next 24 months. We can also expect to see a slowing of the GDP with a risk of further negative readings of the GDP, although the second quarter 2025 GDP reading is expected to be positive because of some aberrations caused by the tariffs and the anticipatory buying in the first quarter. Also, we can expect a slightly lower bond and mortgage rates, as I just illustrated, but only slightly lower over the next 2 years because they are already approximately where they're going to end up. We can also expect, because of the slowing GDP, that we can expect a tightening of lending standards due to the slowing of the economy. That simply means that banks are going to get pickier about who they lend money to. Email us at info@trademarkcapital.com, and should you have any suggestions for future videos, please send them to us and we'd be glad to prepare a video along with the graphics. Thank you for joining us today.